something happened this morning that most investors have not even noticed yet. Silver moved, gold moved, but this was not just another number on a screen. It was a signal tied to a report, a warning from the Federal Reserve, and a headline about Donald Trump that is now spreading faster than anyone expected. Because buried inside that headline is a pattern this country has only seen a handful of times in its entire history. And if that pattern is real, the price of gold will not just rise, it could be revalued completely, officially, by the government itself. Stay with us, because by the end of this video, you will understand exactly why silver just moved, why the warning is getting louder, and why what happens next could change how you look at your own savings forever. All right, welcome back, everybody, to Currency Insight, the channel where we take the news nobody else is explaining properly, and we break it down, simply, honestly, so you're never left guessing what's really happening with your money. Now, before we get into today's story, I want to ask you for something, just a small favor. You know, if you've been with this channel a while, if you've sat through these videos before, morning coffee in hand, just trying to make sense of what's going on with gold, silver, the dollar, all of it, then you already know how much it means to have you here. So if this channel has helped you even a little, would you do me a kindness? Just tap that subscribe button. It costs you nothing, but it tells us you want to keep learning together. That's all it is. A small handshake between us. And one more thing, I'd genuinely love to know. Where are you watching this from today? Drop it in the comments. City, country, doesn't matter. I read every single one, and it means a lot to see just how far this little community has spread. All right, now let's get into it. Early this week, something shifted in the precious metals market that caught the attention of traders, analysts, and everyday investors alike. Silver climbed sharply. Gold followed close behind. And for a market that had spent months drifting lower, this sudden burst of strength felt different. It felt like the beginning of something bigger. To understand why this happened, one has to look at a single report that most people outside the financial world had never even heard of. It came from a private company that processes payroll for millions of businesses across the country. Every month, this company releases its own estimate of how many jobs were added to the economy. And because it comes out before the official government numbers, investors treat it as an early warning sign of where the labor market is heading. This time, the numbers came in weaker than expected. Fewer jobs had been created than analysts had predicted. On the surface, this might sound like a minor detail, the kind of statistic that only economists care about. But in the world of financial markets, small details often carry large consequences. Here is why. When the labor market shows signs of weakness, it tells investors that the broader economy may be slowing down. And when the economy slows down, the institution responsible for managing the nation's money supply, the Federal Reserve, is expected to respond. Historically, when growth weakens, the Federal Reserve becomes less aggressive about keeping interest rates high. In some cases, it even begins lowering them to support economic activity. This expectation that interest rates could soon fall immediately changes the way investors think about gold and silver. Precious metals do not pay interest. They do not generate dividends. Their appeal has always depended on comparison to the returns available elsewhere. When interest rates are high, holding cash or bonds looks more attractive and money tends to flow away from metals. But when interest rates are expected to fall, that comparison flips. Suddenly, gold and silver look far more appealing because the opportunity cost of holding them has gone down. This is precisely what happened this week. The moment the weaker jobs report was released, traders began pricing in the possibility of a more accommodative Federal Reserve. Within minutes, buying pressure moved into gold and silver, and their prices rose accordingly. But here is where a careful observer must pause and ask a more important question. Was this single report truly the reason behind the price movement, or was it simply the spark that triggered a much larger and more important shift, one that had already been building beneath the surface for months? This distinction matters enormously. Financial markets are often driven by two very different forces operating at the same time. The first is short-term noise, the daily fluctuations caused by individual data releases, headlines, and shifting sentiment. The second is the long-term structural trend, the deeper economic forces that shape asset prices over months and years, regardless of any single day's headlines. A single payroll report, no matter how significant it may seem in the moment, belongs firmly in the category of short-term noise. It can move prices for a day, a week, sometimes even a month, but it cannot, on its own, explain a lasting shift in how gold and silver are valued across the global economy. To understand what is truly driving precious metals right now, one must look past this single data point and examine the larger forces at work, the tension building inside the Federal Reserve itself, the historical patterns that tend to repeat during periods of economic stress, and a series of political signals that have quietly been accumulating in recent months. Each of these forces, on its own, might seem minor, Together, they begin to form a picture that serious investors cannot afford to ignore. This is what makes this moment worth paying close attention to, not because of one report on one morning, but because of what that report reveals about a much larger structural pattern taking shape underneath the surface of the global economy. The price action seen this week may simply be the first visible sign of a shift that has been building for far longer than most people realize. And to understand that shift properly, the next step is to examine the institution at the very center of it all, the Federal Reserve, and the extraordinarily difficult position it now finds itself in. To understand what is really happening in the gold and silver market, one must first understand the extraordinarily difficult position facing the Federal Reserve today. It is a position that has no easy solution, no comfortable exit, and no historical example of being solved without significant consequences for the value of money itself. This week, a senior Federal Reserve official spoke publicly while traveling overseas, and his message was firm. He stated that the central bank remained deeply focused on fighting inflation, and that this fight would not be abandoned anytime soon. On the surface, this sounds like responsible economic leadership. A central bank committed to controlling inflation is, in theory, good news for the value of currency and bad news for gold, since gold tends to rise when trust in paper money weakens. But a careful analyst does not stop at the surface. He looks deeper, and what he finds is a contradiction that cannot be ignored. At the very same time this official was promising to fight inflation, another report was quietly confirming that the labor market was slowing down. These two facts cannot comfortably exist together for very long. A central bank cannot aggressively fight inflation while the economy is weakening without eventually causing serious damage to jobs, businesses, and household income. And a central bank cannot support a weakening economy without eventually allowing inflation to rise further. This is the trap. Economists have a name for it. They call it stagflation, a rare and painful combination of slow economic growth and persistent inflation happening at the same time. Stagflation is not a new concept. It has happened before, most famously during the 1970s, a decade remembered by economic historians as one of the most difficult periods in modern financial history. During that decade, prices for everyday goods rose sharply, economic growth stalled, and public trust in the value of currency began to erode. People searched for a way to protect their savings from a currency that seemed to be losing value faster than they could earn it. That search led directly to gold and silver. Throughout the 1970s, as inflation surged and economic growth remained weak, precious metals delivered extraordinary returns, becoming one of the few reliable stores of value during a period when almost nothing else felt safe. Investors who recognized the pattern early were rewarded enormously. Those who dismissed it as a temporary disturbance were left far behind. Now, decades later, many of the same warning signs are beginning to reappear. Economic growth is slowing, inflationary pressure remains stubborn beneath the surface, and the underlying cause is not difficult to identify. It comes down to simple mathematics. The scale of national debt has grown to a level that makes returning to low, stable inflation extremely difficult without significant intervention. When a government carries enormous debt, one of the easiest ways to manage that burden is to allow the currency to lose value gradually over time. This process, often described as monetary expansion, effectively reduces the real cost of debt, but it comes at a price. That price is paid by anyone holding cash because the purchasing power of that cash steadily declines. This is precisely why history matters so much in this conversation. Central banks can speak with confidence, officials can promise discipline, but when the underlying mathematics of debt and spending point in one direction, actions eventually follow that direction, regardless of what was promised earlier. This is the deeper story behind this week's price movement in gold and silver. It is not simply about one payroll report or one public statement from a Federal Reserve official. It is about a structural pattern that closely resembles a period the world has already lived through once before, a period that proved extremely costly for anyone who ignored the warning signs. None of this means the outcome is guaranteed to repeat exactly as it did decades ago. Every economic cycle carries its own unique conditions, and careful analysts avoid making the mistake of assuming history repeats itself perfectly. But history does tend to rhyme, and the responsibility of a serious investor is to recognize that rhyme early before it becomes obvious to everyone else. And while this monetary pressure continues to build quietly in the background, another force has entered the conversation, one that is far more public, far more unpredictable, and impossible to ignore. That force comes directly from the political world, and it centers on one individual whose history with gold stretches back much further than most people realize. While economists debate interest rates and inflation charts, a different kind of signal has entered the conversation this week, one that comes not from a spreadsheet, but from the political world. And this signal is far harder to ignore, because it involves a public figure whose relationship with gold did not begin yesterday. This week, attention turned to a series of gestures coming from the highest levels of government, gestures tied to a national milestone, the country's 250th anniversary. Among these gestures was a symbolic installation involving gold, shared publicly and quickly spreading across financial and political circles alike. To a casual observer, it might look like nothing more than ceremonial decoration. But to anyone who has studied the individual behind it, it looks like something else entirely, a pattern repeating itself. This is not the first time this particular figure has shown a preference for gold over paper currency. Years earlier, long before he held any political office, he made a business decision that few people paid attention to at the time, but which now looks remarkably telling. Rather than accepting a lease payment in ordinary cash, he chose to accept payment in physical gold bars instead. At the time, this decision was framed as unusual, even eccentric. Looking back now, it reveals something important about how this individual has always viewed the difference between paper money and real, tangible value. This history matters because it removes the possibility that recent gold-related gestures are simply coincidence or spectacle. A pattern spanning more than a decade suggests something deeper, a genuine, long-held belief that paper currency carries risk, and that gold represents a form of protection against that risk. But the story does not end with one individual's personal history. Around the same figure, a series of independent developments have quietly been accumulating, each one seemingly unrelated on its own, yet together forming a pattern too consistent to dismiss. There have been renewed calls for a full, independent audit of the nation's physical gold reserves, a request that has resurfaced repeatedly over the years, but has gained fresh attention recently. There has been unusual activity in options markets, where a growing number of investors have placed long-term bets on extraordinarily high future gold prices, price levels that would have seemed almost unrealistic just a few years ago. There have been public comments from senior economic officials referencing the possibility of revaluing assets sitting on the national balance sheet. Comments that, taken individually, might mean very little, but taken together, begin to suggest a broader conversation happening behind closed doors. Separately, legislation has been introduced calling for more transparent and regular auditing of gold reserves. Central banks around the world have also been quietly accumulating gold at a pace significantly higher than what has been officially disclosed, based on independent research from organizations that track global gold flows closely. None of these developments, on their own, proves that a major policy change is coming. A careful analyst must resist the temptation to treat speculation as certainty, but when so many independent signals begin pointing in the same direction, at roughly the same time, ignoring the pattern becomes its own form of risk. This is the essence of serious economic analysis. It is not about predicting the future with certainty. It is about recognizing when the probability of a significant shift has increased meaningfully and positioning oneself accordingly, rather than waiting for an official announcement that may arrive only after the opportunity has already passed. What makes this moment particularly worth watching is the convergence itself: personal history, political symbolism, legislative activity, and market positioning, all aligning within the same narrow window of time. History has shown that such alignments rarely happen without consequence. And this raises an important question for any serious observer of markets, one that leads directly into the next part of this story. If capital truly does begin shifting away from speculative assets and toward something more tangible, what would that shift actually look like? And has it happened before, under strikingly similar conditions? To understand where gold and silver may be heading next, it helps to look at a concept that experienced investors know well, but casual observers often overlook. That concept is capital rotation, the process by which large amounts of money move from one type of asset to another when confidence begins to shift. Money in the financial system rarely disappears. It simply moves. When investors lose confidence in one part of the market, they do not typically hold cash and wait. They search for the next place to put their capital. And history has already shown, more than once, where that money tends to go when confidence in speculative assets begins to break down. The clearest example comes from the early 2000s, during the collapse of the technology stock bubble. In the years leading up to that collapse, enormous amounts of capital had poured into technology companies, many of which had little in the way of actual profit, but enormous public excitement behind them. When that bubble finally burst, trillions of dollars in value disappeared from technology stocks within a short period of time. What happened next is the part most people forget. That capital did not vanish. A significant portion of it rotated directly into precious metals. Over the following decade, gold and silver entered a sustained bull market, rising dramatically in value while major stock indexes remained largely flat for years. Investors who recognized this rotation early captured extraordinary returns. Those who stayed concentrated in speculative technology stocks, waiting for a recovery that took over a decade to materialize, missed one of the strongest precious metals rallies in modern history. Today, a strikingly similar setup appears to be forming. Once again, enormous amounts of capital have concentrated in a narrow group of speculative growth companies, this time centered around artificial intelligence and advanced technology. Valuations in the sector have expanded rapidly, driven heavily by future expectations rather than current, proven profitability. This is not a criticism of the technology itself, which holds genuine long-term promise. It is simply an observation about how capital tends to behave when excitement outpaces fundamentals. Here is what makes this pattern particularly important for serious investors to understand. The total amount of money currently invested in technology and artificial intelligence stocks is enormous, measured in the trillions of dollars. The total size of the global precious metals market, by comparison, is relatively small. This size difference matters enormously because it means only a small percentage of capital would need to rotate out of technology and into precious metals to produce a dramatic effect on gold and silver prices. It is important to acknowledge, fairly and honestly, that not every experienced analyst agrees on the timing of this shift. Some respected voices in the precious metals community have raised legitimate concerns that silver, in particular, could still fall further before any major recovery begins, pointing to historical chart patterns that show troubling similarities to past downturns. Their caution deserves consideration, not dismissal. But even accounting for that caution, the structural argument for rotation remains difficult to ignore. Whether that rotation begins gradually over several months or arrives suddenly during a period of market stress, the underlying imbalance between an enormous speculative asset class and a comparatively small precious metals market continues to build in the background. This is the foundation for understanding everything discussed so far: the weak economic data, the policy contradiction inside the Federal Reserve, and the political signals surrounding gold. All of it converges on a single, larger question that the final part of this story will now address directly